Did you know that in 2024, one particular sector has delivered 300% return over the past 10 years? It's a massive 300% return. If you've not invested in the healthcare sector 10 years ago, then you've not made that return, my friend. Too bad. But that's not what I'm talking to you today about. I'm talking to you about how you can avoid regret from the next 10-year perspective. Are there investments in certain segments, themes, or sectors that you can do today that can help you realize great returns 10 years down the line? But as Spider-Man says, with great power comes great responsibility. Similarly, with great return expectation come great risks. Thematic or sectoral funds are high-risk funds and they are not for all investors. So choose your investment carefully after considering the risk. But before that, let's look at what these thematic or sectoral funds are. Thematic or sectoral funds are funds that invest in a very narrow segment of the market. They will invest in either a theme or a sector that is very, very narrow and very, very focused. For instance, the infrastructure theme will focus its investments on companies that aid infrastructure alone. It could be a cement company, it could be a steel company, it could be a project management company, any of those. But really, what benefits from growth in infrastructure? It's very focused. As a result of this focus, when that sector or segment does exceptionally well, you end up with a great return as well. On the flip side, exactly the opposite. When that sector really doesn't take off, you also end up with a very, very poor result because you are not diversified enough in these funds. So they are high risk, like I mentioned, but also present a very, very high return. To what extent should one be investing in sectoral thematic funds? I'd say if you're a new investor, you shouldn't even be looking at this segment of investing. It's not for you currently. But if you're an experienced investor, if you're an investor who has seen a couple of market cycles and you've been investing for, say, a couple of years now, you want to put a small amount of your portfolio at a higher risk and you have a 10-year time period for this risk to play out, then this video is for you. These are the 4 thematic or sectoral funds which we believe will give a substantially outsized returns to investors who have a 10-year outlook. And these are relatively good new ideas as well. First, defense. Defense is a new theme in India. A bunch of new companies have come into the private sector. They've come in because the government believes that defense is a very, very strategic investment industry and they want more Indianization in that. The Atmanirbhar concept is really at the heart of the defense industry. So bringing down the impact of imports in a big way is what the government is pushing towards on the defense sector. As a result, government is opening all doors to ensure a slew of small Indian companies get their wings out there. These are companies which are specializing in high-tech missile technology to high capability electronics and engineering that go into defense segments. And these are the companies that form part of a defense sector funds. Given that there is a government focus to make this happen and succeed, and in the long term to make India self-reliant in the defense sector, we believe this is a great sector fund to look at. Here are the few points that we think why you should be investing in a defense sector fund. Robust government backing. The Indian government's unwavering commitment to bolstering national defense capabilities has translated to increasing budget allocations year on year and policy support. There has been a continuous increase year after year in India's defense budget, especially relating to the indigenization of defense equipment. The government's thrust not only underscores the sector stability, but also signals sustained growth. India's defense trajectory is looking up significantly, surpassing the $1 trillion production mark, which is a significant growth year on year. The Make in India initiative has also given a new push to this sector. And the growth is not limited only to public sector enterprises, but to private sector as well. The Nifty Defense Index, which tracks the performance of the listed defense companies, has delivered a compounded growth rate of 54.8% in the past 5 years, outperforming the Nifty 50. The impressive return of Nifty Defense Index is the testament to the sector's robustness and its potential to create wealth for investors. The defense mutual funds offer an array of different companies within the defense sector, which involve themselves from a missile program to aerospace industry to naval and marine capabilities, therefore offering a wide diversification for investors to invest, although it being within the defense sector. India's defense has also been on the rise, with government setting ambitious export targets to increase India's defense exports to other third world and other countries. The export potential not only boosts the sector's revenue streams, but also increases the attractiveness for investments into these defense companies. Over the past year, which is of course a very short time, defense funds have delivered a stupendous return in terms of investors invest. Even an SIP of over the last 12 months has yielded almost 30% return to most investors. And this is just the beginning for investors. Consumption is the next theme we would like to explore. India is a young country. Its average age of working population is sub 20-25 years, which means that it's going to have a lot of people who are in the consumption age. They're going to buy cars, they're going to buy bikes, they're going to do a lot of that stuff. As per capita income goes up and India takes its rightful place among the largest economies of the world in the next 10-15 years, you would find that people are out there willing to consume more. They have more money on hand, more money leads to higher consumption. And there are a bunch of industries out there waiting to enjoy the benefits of this consumption. It could be an FMCG company, it could be a durable company, it could be a fast food chain. Many of those industries are waiting for the boom to happen. And therefore, we believe consumption over the next 10 years could be a great theme. Now, what are the companies that would come under consumption? Like I mentioned, it could be the fast-moving consumer goods. Your soaps to your detergents to your high-value products will all be part of this industry. Durable company, your automobile companies, all of these will enjoy the benefits of a much higher per capita income in the hands of Indians. So we believe it's a great future for consumption, but you will need patience and you will need to give it a 10-year period. Here are the reasons why we believe consumption in India will boom. With projection of India poised to be the third largest consumer market globally by 2030, consumption is also expected to keep pace and grow rapidly. The formalization of economy, especially since GST was made mandatory, has increased the participation of large companies into the growth trajectory in a big way. Aspirational Indians are now willing and more than willing to spend on their consumption needs. And therefore, we are finding that a large part of market is moving from an unorganized sector to an organized sector, thereby giving a great fill-up to the listed companies which are in this space across FMCG, consumer goods, and consumption companies. The last 1 year SIP returns, although a very short term, has also shown great promise in terms of a 30% plus returns in this sector. Next, infrastructure. India over the last 20 years has upped its game on infrastructure. The golden quadrilateral that was earlier touted by our Prime Minister Atal Bihari Vajpayee then has really enhanced connectivity across the country. But that's just the beginning. There is a slew of large infrastructure projects right from the bullet train and speedier railways to airports, hundreds of airports across the country linking even the smallest of towns to major cities, to the Bharat Mala, which is your Sagar Mala, which is connecting all the ports, minor ports, major ports, etc., to a slew. So across land, air and sea, there are lots of projects that are underway as we speak. And over the next 10-15 years, you will see India getting transformed in that space. Now, is that an opportunity? Absolutely. Infrastructure Fund is a fund that hopes to capitalize on the opportunity that is presented by this massive change that's happening. And it's important for us to capture that advantage by participating in some of these infrastructure companies. These companies are not new. This segment itself is not new. It's been around for some time. Yet, we believe the journey is not done. There is a long way to go before these companies mature and realize their full potential. We believe infrastructure is a great theme for somebody to participate. Like I mentioned, again, look at a long term, look at a 10-year plus horizon. Here are a few ideas or thoughts as to why you should be investing into an infrastructure fund. India has to enhance its infrastructure to reach its economic growth target of $5 trillion. The population and the economic development requirement in terms of transport infrastructure, including roads, railways, aviation, shipping and inland waterways, is quite enormous. As per the Reserve Bank of India, in the past 4 years until March 2024, real estate investment trusts, REITs and infrastructure investment trusts have amassed $15.6 billion in terms of deployment into their respective sectors. According to Cushman Wakefield report, India's real estate market should see a surge in the second quarter of 2024, attracting $2.77 billion. Development of infrastructure has a multiplier effect on demand and efficiency of transport and increases commercial and entrepreneurial opportunity. In March 2024, the Ministry of Civil Aviation and Steel announced inaugurating 15 airport projects worth $12.1 billion by 2028. The Ministry of Road Transport and Highways opened 15 national highways worth $1.7 billion in Patna and Bihar. FDI in construction development, which is into townships, housing, built-up infrastructure and construction projects, stood at $26.54 billion, moving up to $33.52 billion between the year 2000 and 2023, almost a 30% growth rate over a 3-year period. While these are mid-path for infrastructure funds, the funds have actually delivered a stupendous return over the last 12 months. They're almost yielding a 40% return overall on an average. So infrastructure has done really well in the past year, but really the game is over a 10-year period. Defense done, consumption done, infra done. What's the fourth? Yes, you guessed it right. Manufacturing. India has a huge population of young people, and these people need to find jobs. And the largest sector that can offer that job market is the manufacturing sector. Unfortunately, over the last 3 decades, manufacturing has lagged behind the growth of services sector. But over the past few years, government has earnestly put its energies and machinery behind bringing the past glory back to manufacturing. Recently, the report came that India has enabled $10 billion worth of Apple that was manufactured locally exported. That's just the tip of the iceberg. Manufacturing is really kind of gearing up to do big things. We are going to challenge China, which is the manufacturing capital of the world, in their own game. This is going to be an exciting sector over the next 10 years, and government is committed to making sure that the pace of growth in the manufacturing space is stupendous. From a 17% contribution to GDP, the government is looking at over 30%, and that too not too long, in a 7 to 10 year cycle. The advantages of investing in a manufacturing themed fund. With 17% of India's GDP and over 27.3 million workers, the manufacturing sector plays a significant role in the Indian economy. The Indian government hopes to have 30% of the GDP coming from manufacturing by the year 2030. India's manufacturing industry is a key contributor and is expected to reach $1 trillion by 2025. The sector that contributes only 17% now is expected to contribute 30% by 2025. This sector employs 20% of India's total workforce. Foreign investment. India is an attractive investment destination for foreign investments, with many auto, luxury and mobile brands making India the manufacturing hub for their worldwide markets. Make in India initiative, launched in 2014, encourages domestic and international companies to come and produce goods in India, focusing on sectors like electronics, defense, automotive and textiles. While it's early days for manufacturing sector, the last 12 months returns of the sector has been a very, very good double-digit figure, and it shows great promise if somebody has a 10-year investment window to stay invested. These 4 sectors or thematic funds are great ways in which you can participate in the future of India that we're going to see unfold over the next 10 years. Now, the question that people may have is, should I do a lump sum or should I do an SIP? I'd say if you have money that you can put aside for a 10-year period, lump sum is also not a bad idea. But ideally, I would say take the SIP route over a 10-year period. Believe me, you won't even know you're investing yet at the end of 10 years. You could be sitting on a pot of gold. Having said that, like I mentioned earlier, I would like to reiterate that these sector and thematic funds are for mature investors. So if you're a mature investor who has enough money already invested in mutual funds, in large cap funds, in diversified funds, and so on and so forth, then maybe 10 to 20% of your overall wealth can be allocated towards these kind of sector or thematic funds, not more. With high returns comes high risk. Always remember that. But believe me, if you took equal bets across these 4 funds over the next 10 years, my belief is that you will avoid regret. You've heard about the 4 sectors or themes that one needs to look at over a 10-year period. If you're keen to know more details and need some guidance in this matter, do fill up the form in the link below and we'd be happy to touch base with you.